And I think what we'll do is one of you can ask a question. I'll try to answer, and then if the other ones, feel free to chime in, on that topic. See if there's things that we haven't explained, and then we'll go on, and the next person can introduce a new topic. Okay? So everybody should be ready with one question to ask, and then more maybe.
That sounds good. We're live now, so I'll press the button. We're live now. Welcome to the Hangout.
Well, welcome everybody. It's the last Hangout of asset pricing. It's been a long road, but I hope a fun one. We have a stellar group of students to chat with us today, so let's get right to it. Adam is going to be the master of ceremonies. Adam.
Yes, but I think we should start out. Why don't you briefly introduce who you are and where you're from, and then you can ask your question for Professor Cochran. We're going to start with Zing. Do you have a question?
Yeah. You have to introduce myself. Yes. I'm Professor Ron, and I'm based in China. I'm a student in finance, and I enjoy this course a lot. Thank you, guys. I have two questions about Bayesian portfolio theory. The first one is, in lecture, you show us that the long-run return of stocks can be predicted by dividend yield very well. But we still cannot say that the long-run stocks is safer than short one. And at first, I don't understand why. Now, I'm just wondering that if the Bayesian theory can explain that by uncertainty of parameters. I'm just trying to connect two topics together. And my second question is...
I'm not too old to do two questions at once. Let's start. Let's talk about the first question, and then we can tee up the second one as well. Because you brought up a point, and I like to use this to review the points. One point that we saw is that stock returns forecast dividend yields, and yet if you have the stock returns themselves, they look like a random walk, which is a fun little puzzle that I put you through to try to understand how these things work. And so that means that, now, safer for the long run. Let's just review the facts. Stock returns are predictable from dividend yields, but the variance of long-run stock returns is K times the variance of short-run stock returns. So how do you put that together with portfolio theory? Well, the real answer is portfolio theory. If we're in this world, portfolio theory isn't just mean variance. You don't just go, what's the Sharpe ratio at the horizon, how much do I put in stocks? You have to do the proper Merton portfolio theory. So that even in this world, the predictability, one thing it does is it gives you this hedging demand. So the fact that when prices go down, expected returns go up, means stocks are sort of like bonds. They're even less risky than we thought. That kind of less risky is still there. So the important thing is that, so this fact that variances don't get lower as you go to longer horizons, that's the key is that's really not the way to do portfolio theory. The right way to do portfolio theory is the right intertemporal portfolio theory with the Merton hedging demands and so forth. So that was question one. You already got two questions. Question two is, how can Bayesian portfolio theory solve this? Bayesian portfolio theory really isn't about changing the fundamental parameters. It's about dealing with your uncertainty about parameters as an extra source of risk. So Bayesian portfolio theory, in general, what it does is it ends up shading you back towards, look, I'll just hold the market, because any of these models are uncertain. It just it recognizes that model uncertainty is risk to you, the investor, and makes investments riskier. So it's not. Bayesian portfolio theory isn't going to solve the problem. It's not going to change the puzzle. But Bayesian portfolio theory might. What it will do is tell you just relax and don't take the advice so strongly. Okay, let's see how that worked. Adam, Nina, do you have a comment on this question?
No comment. It was a good question.
Did I answer your question, or did you want to go on to your follow-up question?
Yes. My second question is can I say people can forecast long-run return by dividend yields, but they don't buy anymore because they are afraid of the uncertainty? Does that mean the expected return is the maximum expected return when the uncertainty is given? So we can run regression to find expected return and find a variance, and so we find, and then we find a real long-run mean variance frontier in this way, maybe.
Yeah. So first, one thing I want to emphasize is I've done dividend yields, and that was a sort of a textbook exercise, and it's not the beginning and the ending. When you think about the facts of the world, there's lots of other variables that forecast stock returns. Yes, so what we found is that dividend yields, among other variables, can forecast stock returns, which makes it look like, hey, I can go out there and buy when prices are low and prices are high. But these are very long-run things. You're not going to start a hedge fund based on it. And the sort of explanation that I kind of like of this is that it reflects people's varying willingness to bear risk. And we've just seen this in the last couple of years. In 2008, 2009, in the bottom of a recession after a financial crisis, prices went down, expected returns were higher. If you could buy stocks in March 2009, boy, could I wish I had gone back and bought stocks in March 2009. Everyone else was scared, expected returns are high. What are we living in right now? Stock prices are high, price-earnings ratios are high, all these indicators are high. What are the newspapers saying? There's the great reach for yield going on. As usual, the newspapers want to talk about central banks and the Federal Reserve and so forth, but let's look around. It's not booming economic times, but people seem to be willing to take on risk. So you've got this sense of time-varying risk aversion right there. Now, let's integrate that with portfolio theory. What does portfolio theory say? I have to say about that. Well, if you're different from everybody else, in 2008, 2009, if everyone else is getting scared and you have reasons not to get scared, then you buy. Now, if everybody else is reaching for yield and you have your reasons to be more scared, then you don't reach to yield and you steal. So you should do things based on how you're different from everybody else. I think that's the best I can do to think about how these time-varying things relate to portfolio theory. We got so many people. We could keep going for an hour and eight. So let's go on to the next one, and Jane, you can come in if I don't answer someone else's question, you can help me out. Adam, who are we gonna bring up next?
The next one in line is Chris. Chris, why don't you introduce yourself and ask your question?
Okay, thank you. My name is Chris. I came from Taiwan, and I will do my RA at National Taiwan University. I'm extremely interested in this course, and I want to ask a question. The question is that in my master's degree, I have a thesis about investor sentiment. After 14-week courses, I want to know, does investor sentiment really play an important role in its pricing and the returns? Yeah, because I studied that Becker and Walker argue that the price of something that hard to be evaluated are affected by investor sentiment very much. So I'd like to know how about it work. Yeah, thank you.
Yeah. No, I'm smiling because boy, Adam and Nina know I'm about to get myself in trouble here. I haven't been a big fan of the investor sentiment stuff, and I'll tell you the difficulty. Very difficult to. So there's a temptation to say stocks went up. What happened? Oh, investor sentiment must have gone up. Stocks went down. What happened? Oh, investor sentiment went down. Okay, thanks. That's a nice story. So how do you get beyond sort of telling stories about what happened into something that sounds like a sort of scientific model? You need some way of independently measuring sentiment and not just using it as a story for what happened ex post. So I wish my colleagues luck who are doing that. As I see the challenge is to come up with both models that can't explain anything that happens. I mean, a joke I've told many times before, our ancestors would see a good harvest and say the gods are happy, and they'd see a bad harvest and say the gods are angry. We could do the same thing for asset pricing. We call it sentiment. Okay, but let's get the measure of a theory is not if it can explain anything. We're not here to explain things after the fact. We're not here to write op-eds the next morning and saying, oh, markets went down, there must have been sentiment. You need a model that can't explain anything, and you need an independent measurement of sentiment that you can say sentiment went down, I predict that the markets will go down, and then you see the markets go down. Now, that's not happening, and there's an interesting thing going on. The guys who do sentiment are actually challenging sort of that scientific, we shouldn't be doing science at all. Maybe we should just be telling stories. Well, maybe we should, but I'm less interested in that. So anyway, that's where I see that what you're getting is sort of the grand, where do I see behavioral finance going? I think that's one of the big challenges is to make these things not vacuous and independently measurable. The other challenge is what's going on right now in asset pricing. Much more attention. There's sort of three big views. There's the view we've done in this class, which is economics, rational, frictionless. There's the behavioral view, which says, oh, there's psychology and sentiment and so forth, but the markets are still pretty well functioning. The biggest challenger right now is the financial frictions view, that people are fully rational, that it's not about people misperceiving things and having sentiments, but it's rather about the problems of markets and leverage and collateral constraints and so forth. So that's where we stand. Got to make up your own mind, and there's all sorts of interesting things going on. That, in a short version, that's the best I can do. Adam, Nina, is there anything I can follow up about that and be a little more precise?
I think that's a good summary. It says it's our job as students to challenge some of the views that are out there. So one of the things that I'm working on is I want to see, can we actually be scientific about sentiment and quantify this and test the theories? And there's a lot of machine learning techniques out there. So I'm working on a project where I have an algorithm that reads newspapers and see, can I, from the machine learning technique, read newspaper articles, come up with a measure of sentiment, and can that measure predict anything? Obviously, this is potentially controversial, but I think it's an important step forward to use the computational techniques that we have to be scientific about the stories that are otherwise just stories.
That is wonderful. Yes, and what you're doing there is you're integrating two data sources. You're saying is what I read off of Twitter feeds at least consistent with what's going on in the market. So, yeah, that's an example of how to go forward. Let's see, reading. If you're interested in sentiment, these sort of things, yes, you found the Baker-Werkler. Any other big things they should read, Adam, Nina?
I'll think of something and post it on the forum.
This isn't your. That's a good point. Okay, this was fun, but everyone's got to get a turn. Who's next?
Good. Next one in line is George. George, why don't you introduce yourself and ask a question?
Hello.
Hi, George.
My name is George. I'm from Greece. I work for an FX broker, and I have an MSc degree in economics and finance from LSE. I have one question. It might sound a little simple. It has to do with the last week's material, the first lecture. And at some point, we equated 0 equal max consumption plus rho times value, and then we used the Ito's lemma. Sorry. The things that I don't understand this step. How did we do it? And somehow a delta or a dt term seems to vanish. So I got confused a little bit. And then I don't understand how we first introduced the Ito's lemma in order to get those W times W terms. This is what confused me.
Oh boy. I'm not going to be able to do algebra off the top and get it right. I do have my board here. Let's see if we can do just the basic. If I can, and Adam, Nina, help me to get this right. So the basic. This is So what we ended up doing here was continuous time dynamic programming, and we did it in 30 seconds. So I admit that was a little bit ambitious and a quick thing to do. This stuff is much easier in discrete time, where the value function is defined as the realized value, the maximized value of expected sum of beta to the t u of ct. Can you guys see that?
Yep. Yeah.
So that's the definition of the value function is as a function of your original wealth. Given original wealth, what's the total value of happiness? It's the maximized value of happiness. So that is the value function. Then in discrete time, what we do is we go value of wt equals max u of ct plus expected beta value w.
Okay.
So that's what we're doing in discrete time. And this is just a wonderful way of doing these problems, because instead of having to pick consumption and portfolio weights at every date in the future, all you have to do is decide today's consumption and then the asset returns that get you to tomorrow's. Now, what we did, where you get stuck in the algebra was the step problem. Adam, help me out here. I'm getting some feedback. Do you know what? Does this sound, Adam? Is this sounding okay to you guys? Okay, I think we're all set. Now, what we did in the lecture was to do this all in continuous time as well, and you can see what's happening here. From the VWT plus 1 to the VWT is where we're going to get a D V term. How does V change? And then you operate Ito's lemma on that. I'm not going to be able to go through the Ito's lemma algebra here because I'm going to get it wrong if I try. It'll also take me an hour. But let's make sure to follow up with a forum question on going through exactly where we got lost on that algebra. So if you can post a question to the forum, Adam, Nina, keep me honest, make sure we answer that question on the forum of exactly where that piece of algebra is confusing, and I hope not wrong. Did that help? I hope so.
George, I muted you, so you need to unmute yourself at the top of your screen.
Yep, it helped. Everything is easier in discrete time and more intuitive. I got it, but I just got confused somewhere around the algebra. I will try to ask a very detailed question in the forum.
Yeah, and I'll see if I can. I'll go back in the forum and see if I can get all the intermediate steps and make it clear. You're exactly right. Discrete time dynamic programming is very intuitive because there's this utility of consumption and value of future wealth. And you can see I'm trading off, you know, how good does it feel to eat today versus how much less do I have in the bank? That's the value of wealth term. And each term, in continuous time, I still haven't found the intuition behind all the terms, but you know, step by step, you go, yeah, there it is. So if someday I'll have deep stories to tell about each equation, but not yet. Okay, let's go. Let's do the next. Oh, George, yes, go ahead.
Just may I intervene if I got this right. For example, let's say that I have to walk from Greece to Chicago, and I have to go on foot. If we think about every single step, it's very difficult. The easiest thing to do is to learn how to walk. The initial condition will be Greece, transversality condition will be Chicago, and then you just have to start walking, something like this. You need one step after the other, only 2 steps to find this. It's like an Euler equation in discrete time, right? Do I get this?
Another way of putting it, suppose you want to go from Menlo Park to Palo Alto, and rather than figure out exactly the path, what you could do is, of the 3 choices you have right now, figure out what is the minimized distance. If I go 1 block here, 1 block there, 1 block there, what is the distance from there on? and if I know if I know how much it takes to walk from here to the next choice, and then the total distance from there on, now I know how to make the immediate choice without having to do the alt path right at once. Exactly.
Okay.
Then take derivative. Ito's lemma. Let the dz's and dt's do their magic, and next thing you know, you've got a differential equation to solve. Sounds easy. Okay, next, and thank you, George. George, also thank you for putting up with my jokes in the previous Hangouts. Adam, who's next?
Yuki, go ahead. Yuki is.
Hi, Yuki.
Hi, let me introduce myself briefly. I'm a PhD student in economics. So in Tokyo, I'm going to continue my study at the US. And I have one question, which is not directly related to the lecture, but possibly related to the last lecture. So I have read a paper on high frequency trading, and they say that they are making money in the high frequency trading. But in the last lecture, you said that if investor and alpha, positive alpha, then they have some different characteristics. So what is if you have any take on why they have some can earn more positive, and so how should I, if they have such positive alpha, and how should I interpret their alpha? So that is my question.
That's a great question, and let me cheer for. So I think the mechanics of trading is something that is a big research area right now, and I think very interesting. And things don't work the same way at milliseconds that they do in regular time. So when I think of when I see what's going on with high frequency trading, that certainly is somewhere involved with the process of how does information get into markets, which is something we haven't touched on in this class at all. If you'd like, this class, the models we've done in this class have a prediction, and that is that when a piece of news comes, the price jumps, there is no trading volume, and that's the end of that. Now that's a prediction. That's not how the world works, right? Piece of information comes, huge amounts of volume, somebody's buying, somebody's selling, the whole high frequency snowball goes along. So we don't really understand that. Certainly people who are making money if they are at high frequency trading. I'm not, you mentioned my stories about different characteristics and so forth. That's not it. This has to be about traditional, I have information that you don't have kind of alpha at very high frequencies. What I was trying to do there is so there's this whole information thing about efficiency, and alpha is information. The big point I was trying to make in the lecture is that since we live in a multi-factor world, there is a source of alpha relative to the market that's perfectly sensible, which is I bear a multi-factor risk you don't want to bear. So when we're thinking about longer frequencies, like why do value portfolios outperform growth portfolios, and managers who do value get cap M alpha out of doing value. Do we have to think about that as information not in the market? No. There is at least a story about why a value premium lasts. Now that's something very long lasting. That's not the millisecond stuff. When you think about what you said in high frequency traders, they're making money about millisecond price movements if they're making money. And that's got to be something about information and the mechanics of how markets work, which I would just, I could give you an impromptu lecture, but I won't. But I think that's just a very exciting research area because we have now tons and tons of data and all sorts of things going terribly wrong in the markets. There's lots of these little flash crashes. The poor guy in London who just got thrown in jail for spoofing. Those kinds of episodes are clearly indications not just that prices aren't random walks, but that there's actually things not going right in the high frequency markets and people who are making money. So that's I'll pretty much leave it. Yeah, the stories I was telling about portfolio theory in the last week are not aimed at high frequency. They're aimed at this kind of lower frequency stuff.
Okay, so is it a bit difficult to interpret the actions with the traditional the theory? Is it correct? What
Yeah.
you say? Yeah.
Yes.
Yeah.
I mean, our standard theory is really about once the mechanics of markets have settled down. It's not about a millisecond. Can you get in when all the other orders aren't in there and that sort of stuff. So, you know, and even in the market structure, typical market microstructure papers will think about, you know, there's a book and then people placing orders, who can get the order in and out fastest and so forth. The interesting thing, the thing that I think we sort of have an idea of, suppose I have a piece of information and you don't know if I'm a liquidity trader or an information trader, and then the market does. What we don't have a good model of is what we see happening is those people in between, where they don't particularly have any information, but they're watching the markets. So they see one guy come in and start trading, and they think that guy might know something, so they pile on. That function is one we don't really have good models of yet, and that's what I think I see. Somebody comes in with some information, and it's not just about the bid-ask spread and him. It's about these other people who are you know, exploiting price patterns to try to front run him and that kind of stuff. So all very fascinating stuff that we haven't talked about in this class. And the portfolio theory lectures were not at all trying to get at that kind of question. Nina.
Yeah, I have something to add here. I think there is currently a big research question on whether high-frequency trading improves market efficiency or not. I've been on the conference on high-frequency trading, which was dedicated only to these questions, and so far the evidence is mixed, and it's still not clear whether high-frequency traders help to improve efficiency on the market or not. So that's potential for further research.
Yeah, and I would, as usual, people have jumped to the public policy answers too quickly. How does high-frequency trading work? What is going on here? Here's one question we don't know the answer to. And second, to the extent that high-frequency trading is making matters worse, is that because of sort of the evils of markets, or is that because of the silly unintended consequences of a bunch of regulations we have now? And I think there's a strong case for that second one. In the U.S., the Securities and Exchange Commission and the Commodities Futures Trading Commission, they're the ones who set up markets that says there has to be lots of different markets, but you have to get the best price from around these markets, forgetting that sometimes these come in with millisecond delays. They're the ones who said that you get the full allotment if you come in 1 nanosecond earlier than the other guy. So I think there's a lot of scope for markets could be, there's a lot of pathologies, some of which come from the regulations and not just the markets themselves. And these are markets that we as economists don't really understand how they work in the first place. So it is, as Nina said, this is an exploding research area and a lot of fun. Okay,
yep. Next. Briefly, if you want a reference on the current state of some of active research on high-frequency trading, there's a new paper called High-Frequency Trading Arms Race by a professor here at Chicago booth, Eric Budish, and Peter Kremsen, and one of my PhD colleagues, John Shim. So I'll post that on the forum, and you can read more.
Great.
The next one mine is Arjun. Arjun, why don't you unmute yourself and introduce yourself and ask a question?
Yes, I'm Arjun. I work as a researcher at the Cambridge Judge Business School here in the UK. And I have a question on systemic risk. So I've read this somewhere, I don't remember where, but the general consensus is that most of the asset pricing models do not sufficiently explain the prices during systemic events, for example, during recession or crisis. So how do we reconcile this fact? Do we just model them as information shocks or investment shocks, or is it something else that we need to use econometric techniques to be, to integrate them in the existing models?
That's a great question. So I'm going to be, I guess, I'm going to put on my grumpy economist hat because it's 8 o'clock in the morning. be careful that there's a lot of these words tossed around, like systemic and liquidity and spiral and fire sale and so forth. That nobody, and then a good question is always, could you define that, please? Right? What's contagion? What's systemic and so forth? It's sort of like there's the old joke. Well, it's sort of like you know it when you see it. Now there is. We had an event. We had a financial crisis. And certainly understanding asset prices in the financial crisis that's like been a huge thing people are looking at. And the standard sorts of models, now standard sorts of models is not so much econometric, but the financial frictions are getting in the way. The standard story is, for example, an intermediary like a bank is about to go under. Its idea of risk management is we'll sell everything if things go bad. It sells everything in the market. The market is thin. The prices go down. Chaos follows, and so forth. Now, do ask yourself, does this make any sense? Your fire sale is my buying opportunity. But nonetheless, that is so. To the extent there's actually a consensus, that's the consensus model. I did in the discount rates paper. I did sort of raise a little bit of a flag. Wait, it's not hopeless that some of the broad effects here are also understandable in terms of classic models. The stock market went down. The stock market, every single person in the U.S. can buy stocks if they want. You don't need leveraged intermediaries. But there's these little arbitrage spreads. There were arbitrage spreads. Things went nuts in markets, no question. There's a danger here. You guys as PhD students, it's now been 6 years. So papers, what happened in the financial crisis, are going to start getting stale. And you certainly don't want to write a paper about the last crisis just as soon as the next one breaks out. You know, the poor guys who wrote papers, why are internet stocks so high? They just had them at the second round of refereeing when the internet stocks collapsed. The papers on the great moderation of 2006 had just gotten them back from revise and resubmit when the financial crisis came. So explaining the financial crisis is getting a little stale. But I think the enduring lessons there are to what extent are financial frictions important in the regular day, everyday function? To what extent are markets still exposed to big shocks that they can't handle? You know, there's a capacity. Short selling is a great example. There's sort of a capacity to do it that the markets have, and markets look pretty frictionless and efficient as long as you don't hit the capacity, and you need them to do 10 times more shares than they're set up to do when things kind of fall apart. And that kind of robustness, resilient, is an interesting thing to study. So let's see. You asked about systemic risk. It's still it's a policy question. Sort of everyone kind of realizes that the first round of policy, that that we're going to regulate everything that calls itself finance approach is not going to work. So how are we going to avoid systemic risks? Markets are, all these high frequency things, they're getting worse. Many markets, even treasury markets, are getting less and less liquid. And so studying those kinds of frictions and pathologies in a current context, I think, is one of the most fascinating things to do. In some sense, I owe you guys an apology. This class, we only touched the surface, and what we're getting, this is actually turning into a great hangout, and we're sort of outlining all the things we should do in the second year of our Coursera PhD program. But that's what you have to go do in other places. Anyway, you want to follow up? Did I say anything helpful to you in there?
Oh yes, I just wanted to push you a little bit in that direction. So this is related to the practicality. So for example, the idea is that you would hold a stock which would be negatively correlated with the market, so that during, for example, in a recession, you would have a slightly higher consumption that you would usually do. So it's good to have a stock like that, but in the practical sense of the term, who is going to buy it from me? So how can I encash it? How do I eat out of it? That's the question that I would like to know.
Well, the whole point is so let's. I was presuming their liquidity. So the idea of it goes up when the market goes down means that there's people clamoring to buy it from you. Now, I think your concern is that the price that the price is false, that it looks like it's a high price, but in fact there's a bid-ask spread and I actually can't get rid of this stuff. Yeah, and so my comment was, but let's distinguish, this is very important, let's distinguish the level of price from the liquidity at that price, from the ability to transact at that price. And let's see, Lasse Peterson had a nice paper on the on various kinds of liquidity, and it could happen that it's not so useful for you if the midpoint of the bid-ask spread goes up in a recession, but then the bid-ask spread widens and you can't actually sell any at that price. Well, that makes it, then we're not measuring the right beta in the first place. Maybe the betas should reflect your ability to buy and sell stuff. Now, there's a deep point here. We're into liquidity, which we also haven't talked about this quarter. I think one of the biggest fallacies, unchallenged fallacies out there, is this idea that risk management consists of, oh, it's okay if we lose money, we'll just start selling stuff. And even our beloved central bankers and regulators, they're now saying, oh, everybody has to have lots of liquidity so that if you get into trouble, you can just sell stuff. Yeah, sell stuff to who? The whole idea of systemic, so my joke version of it is, it's like the approach to airline safety is make sure everybody has $200 in their pocket so that if the engines quit, they can buy a parachute. Well, there's only 2 parachutes on the plane, so it's not going to do any good. Anyway, so I think what you've gotten is this important distinction between liquidity and levels of prices, and that whole can you buy stuff is crucial to the nature of systemic. Can you individually sell stuff if you lose money is very different from can we all sell stuff if the entire system goes down. That's, in some sense, the heart of systemic risks. And let me applaud the whole research question. Are we primed for another financial crisis? What are we going to do about systemic risks? Are things going to seize up again? Yes. Let's see. No, are we ready? No, have we cleared everything up? Yes, is it ready to seize up again? I'm kind of cynical, but that's a great thing to do. So Adam already said, don't take advice from old people like me. Challenge what you hear. And I'll add, don't, look for new questions. All the sort of conventional wisdom is, you don't want to do, oh, here's a research topic started 5 years ago, I'll do something new. It's endless on it. I mean, these are the topics of the moment. So those are good ones to work on.
Thank you.
Adam.
Yeah.
Yes, please. Oh yeah, because you're into this stuff.
Since I do my research on liquidity, I cannot be silent right now.
I know why you be silent.
So I do research on liquidity on the FX market, and the FX market has been always considered as the most liquid market in the world with the highest trading volumes. And what I found that in crisis times, liquidity of even the most tradable currency pairs like euro dollar or Swiss franc dollar, liquidity on those currencies drops 3 to 5 times, and you have to pay more if you are doing carry trades or other kind of currency transactions. And also liquidity is different for different currency pairs. Obviously, liquidity on euro dollar is much higher than liquidity on Ukrainian hryvnia against dollar. So there is a time series variation, liquidity for a fixed market, and also cross-sectional variation. And you shouldn't think of even a fixed market as the most liquid in the world.
Yeah, liquidity is another one of those terms, by the way, which is very hard to define. The one thing I would add to what Nina said, the standard story for liquidity is that markets get less liquid. Markets are liquid if people don't think you know anything when you're buying or selling. You can go in and say, look, I want to buy 10 units, and everybody kind of understands you're selling 10 stocks because you want to buy a car, not because you know something. And so in these aggregate events, the reason people stop trading is all of a sudden they start thinking, oh, anybody who's buying or selling something knows something, and I'm going to get stuck with something bad. That's why things get illiquid quickly when they used to not convey a lot of information, and all of a sudden there are people with information around. The other thing I'd add is like anything else, there's supply and demand for liquidity. So high volume, Nina mentioned, high volume doesn't always mean liquidity. I've seen cases of very high volume with very high bid-ask spreads. Now, how can you get high volume and high bid-ask spreads? Well, that's because there's a huge demand to trade, and in some sense, not so much supply of trading. High volume can be a sign of huge demand to trade despite illiquidity, as opposed to a sign of lots of easy trading. So, liquidity, another great thing in our year 3 of our Coursera class will be all about liquidity. Actually, I have it's a little bit outdated, but there's a set of liquidity readings on my faculty webpage. If you go to classes, I taught a class on liquidity a while ago. And also the readings in my MBA investments class on high-frequency trading and liquidity are a place to start. And, of course, Nina's paper. Right, Nina?
Yes, Understanding FX Liquidity, it's how it's called.
Is this the one that, so Nina just got a paper accepted in the Review of Financial Studies, which we're all celebrating today?
Yes,
right?
Yes, it is, this paper, yes.
Congratulations to Nina.
Thank you so much.
Okay, who's next?
I'm quick question on the topic of anecdotes to explain liquidity. John had the story about getting money to buy the last parachute. Doc Diamond here at Booth has a story about why one of the paradoxes of regulating with central commercial or investment banks. So the current liquidity regulation in the Basel III says that you have to have a sort of a minimum level of liquidity in the bank. So the equivalent of saying at every train station there needs to be one last taxi cab in the line. So the last taxi cannot leave the train station. But then the taxi can't be used. So if you're the last guy that arrives at the train station, you can't use the taxi because the law says that there has to be one left. That's kind of the same with liquidity regulation. If there needs to be a minimum ratio of liquidity, you can't use it in the crisis where you need it, which is kind of a paradox. And he has a new paper on his website describing this.
That is a great story. Thank you.
I think the next in line, should we do that?
The whole problem with liquidity is where are the buyers. It's not about the assets. My story about the parachutes. Yeah, you can have assets that are now liquid, but if no one's going to be around to buy them in the crisis, then it doesn't matter if the assets are liquid right now. So this whole risk management plan of we'll sell to the Martians when the whole economy goes down has this fundamental problem. And I see a lot of, the theory of finance in this class depends on people, some unconstrained deep pocket investors around willing to buy stuff. And if those people aren't around, we're in deep trouble. Anyway, so on to the next question. Adam, or Nina.
Yeah, so we have a question from Ricardo. Ricardo is with us, but unfortunately his microphone doesn't work. So he's asked us to read it out loud. Is that okay?
Hi, Ricardo. Wave and say yes. Okay, that's Ricardo. Hi there.
All right. Ricardo has a question about sort of arbitrage opportunity or activity. In our current economy, spreads to engage arbitrage activities, or alternatively sort of disparities in taxation among countries that give birth to these type of arbitrage opportunities. Or said in another way, if there's a crisis, does that induce big spreads that will change behavior?
So Adam, your microphone was coming in or coming out. Can you what kind of arbitrage opportunities are we talking about here? Can you give an example of what you have in mind?
I'm not sure. Ricardo, can you write what you were?
I love the technology we're inventing here, guys. This is just fun. Yeah, I wasn't able to read that.
All right, so can you see the chat, John?
Spreads. Well, okay. So real arbitrage opportunities are rare. I'll tell you about one that I know about. and I wrote about this in the discount rates paper. In the financial crisis, there's two ways to get some security. So you can buy a corporate bond, or you can buy a treasury bond and a credit default swap. And in the financial crisis, those two ways of getting the same cash flow had different prices. And that was technically an arbitrage opportunity. But unfortunately, when you look at the trade you have to do to make a free dollar out of it, it involved borrowing. And nobody was going to lend you money in the financial crisis. The same thing happened between so covered interest parity. There's two ways to save money in the U.S. You can get a 3% short term. You can invest, say, 3% short term, or you can buy euros, buy a euro bond, and then buy a forward contract to bring it back to dollars. Those two things should give the same rate of return. They did not in the financial crisis. Could you arbitrage and get rid of it? No, because you had to borrow dollars. Arbitrage opportunities show up all the time in the term structure of interest rates. Another student at Chicago, Aaron Pankostas, wrote a great paper on this, where you can see bonds. The classic case is the one that long-term capital made money on for a while until it didn't. The 29.5-year bond and the 30-year bond have different prices. And you go, what the heck? I mean, big differences in prices. Well, the problem is the only way to undo that arbitrage opportunity is to short the 29.5 bond, buy the 30-year bond, and then wait for 30 years. And by that time, the short costs have eaten it all up. This happens also between this, like Royal Dutch and Shell as an example. There's two securities listed on different exchanges can have prices different by as much as 10 percentage points. And you look at it and you can't undo it. Now, these are still puzzles, because who is buying the high-priced one when a low-priced alternative exists is a little bit of a puzzle. And they get worse. They're definite signs of trouble in financial crisis. As Ricardo's writing, if you can exploit it, the problem is arbitrage opportunities that you can exploit vanish quickly. Arbitrage opportunities that we see in the markets persisting are ones that it's not easy to exploit. So they're not really trading strategies, but they're puzzles for our view of why are markets what they are. And now the question is this the tail or is this the dog? In the financial crisis, these spreads opened up. Now is the picture the whole market falls and some things fall a little more than others? Boy, that's a puzzle. They should have felt the same amount. Is the fact that the arbitrage spreads came up related to the fall? Or is it, which caused which? Did a big fall cause arbitrage spreads to open up, or did the kind of pathologies that arbitrage spreads are cause the big fall? That's the question we can argue about. I kind of take the conservative view. Markets fell for other reasons, and then, one thing fell 92 cents and the other one fell 93 cents. Boy, there's an arbitrage opportunity, but the fact that they fell was the bigger thing. That's all I got to say about arbitrage for the moment. Let me know when you find one.
Can I follow up with a question, John? So you mentioned sort of the covered interest rate parity, which I guess widened a little bit and then got back together. And then you mentioned the CDS bond basis for corporate bonds, which to my impression was wide for years or so. I don't know, 9, 10, and 11. Could one imagine that not sort of the end-use arbitrageur, maybe the corporations themselves were affected in their ability to issue bonds? So I don't know this literature well, but I've imagined that corporations' time when they issue bonds or buy back shares relative to whether it's a sort of try to time the market in a raw business sense. Do these kind of arbitrage opportunities in corporate bonds, could they affect real economic outcomes in this direction?
Yeah, that's a good, or at least there are ways to take advantage of arbitrage opportunities other than trying to arbitrage them, because the whole point is there's frictions that don't let you arbitrage. Yeah, invent new ways of undoing the frictions. In some sense, the credit default swaps themselves were a clever invention to get around, mispricing, if you will, around the differential pricing between bonds. Well, I don't know if I want to call them arbitrage. Why were credit default swaps invented? One good reason is, suppose you think a bond has too high a price and you want to short sell it. Very difficult to do. You have to borrow the bond from somebody who's willing to lend it to you and then sell it, and that's a big costly thing. Credit default swaps were an invention to get around the difficulties of short selling bonds. So maybe one answer to arbitrage opportunities is, here's a business opportunity. Figure out a way to get around those frictions, and then you can make some money. Yeah, so potentially yes, but let's go on because I don't have anything intelligent to say about it.
Can I say something? I've thought of two other arbitrage opportunities that I've heard of. The first one is cross-listing on different exchanges. So the same stock can be listed on one exchange and on the other exchange, and there can be price deviations of those, and you might profit from that. And the second example is the exchange trade funds of which track some indexes, for example, ETH, which tracks S&P and S&P itself. There are some studies who find that there can be arbitrage between those.
Well, let's there can be prices for similar things, for very similar things, can diverge. And typically when that happens, it's a situation where it's difficult for you to short one by the other and just wait for it to close up. And that the stocks on two exchanges, I remember there's one example, I think HSBC was the example, where the stocks on the two exchanges diverged by as much as 10%. But I worked it out. The 10%, suppose you just, the 10% difference, if you buy one, short the other, and leave that on, that'll get you 10 basis points a year. Now, 10 basis points a year isn't enough to overcome the transactions cost. So apparently large price differences, when they correspond to small return differences, because they're very persistent, are difficult to arbitrage away. So it's an interesting question. The question is, how close are we to efficient? The returns can be 10 basis points away from efficient, and the prices can be 10% away from efficient. If the price difference is always going to be there. If it's just I buy the same set of dividends at a high price versus a low price. Now, of course, the problem is it still doesn't mean markets are rational, because who's buying the high-priced security is a big puzzle. Now, I know the answer to that. Index funds. Who is the irrational investor when there's a jointly listed security? One exchange it's 110, the other exchange it's 100. Who's the idiot who's buying at 110 when they could have bought it at 100? Well, all of the most famous quantitative hedge funds, all of the indexes who have to buy one of everything. There's anything that doesn't program into the computer, oh, by the way, notice joint listings and buy the cheap one, is going to end up buying the expensive one. So there are these spreads, and they're interesting. They're measures of where we're back to what we've been talking about a lot today. Where there's frictions at high frequency, there's frictions temporarily when the markets sort of have a capacity for buying and selling, and when you ask them to buy and sell 100 times more than they're used to that day, things kind of break down. We rely, for arbitrage, we rely on things like short selling, which has their costs and has their bounds, and the prices can get out of whack. And increasingly, we're having these flash crashes. There was another flash crash in the treasuries, which is a temporal. It's not two things at the same time that have to rub. It's clear when you see something going down 10% in 5 minutes and coming back 10%, you know something's wrong. and this is all part of this fascinating market frictions. Now the big question is, are these the tail or are these the dog? Are these kind of isolated little curiosities, very interesting for revealing how markets work, or do they feed back and affect the overall level and functioning of the markets? Or can you and me just see a flash crash coming and say, I'll go have a coffee and I'll sell tomorrow? That's the big issue. Now we've had a couple of Adam. I was trying to talk, so I wasn't following the requests. We had a couple of requests. You're in charge, Adam, of what we're going to do next.
So, originally, I had Nick next in line. I'm not sure. Nick, are you still with us? you can unmute your phone. If Nick is not here, I can see that Chris asked a question. Chris, why don't you go ahead and unmute your mic and ask your question?
Sorry, guys, I'm still there.
Oh, Nick.
Nick is still.
Yeah,
Okay.
I'm following you guys quietly because I didn't have much to add. So yeah, John, thanks very much for holding this chat. I had a quick question for you.
Yeah, go for it.
In asset pricing models, I mean, I know you kind of partially answered that in certain scenarios they don't work, but then kind of what is the alternative framework that you would recommend?
For what? I'm sorry.
To price for pricing assets in which will work in most in all the scenarios.
Whoa. I think I'll retreat to my aphorism. Which model you use depends on what you want to use it for. And I think that's the art of finance is we don't just say P equals E of MX and there's one grand model that we use. It's very much a practical, it's like engineering. We use different models for different purposes. So, if your boss has said, go tell me what Burger King stock is worth, I think you might want to go look at what McDonald's is worth. If your boss has said, should we invest in value stocks for the long run, then kind of the what are you exposed to, what everybody else is exposed to is worthwhile. If you're trying to answer, if you're trying to get into a debate with a behaviorist about are markets rational or not, then you need a different kind of model. If you want to try to integrate what are the effects of financial crisis on the macroeconomy, then you need something more like these consumption-y models that we've been talking about. So, what purpose do you have in mind, and then we'll figure out what model. I think that's the right way to go about it.
I mean, in most scenarios, I mean, like, we know that CAPM doesn't work because of the irrationality of the behavior. So is there a way to kind of add components to the CAPM and basically measure the behavioral bias of the people? And then kind of...
I'm not going to let you get away with that. So we know the CAPM doesn't work. We don't know that it's because of irrationality of people. That's a long way to go. The CAPM works beautifully on a lot of things. So the CAPM is always a great place to start. If you're evaluating mutual fund managers who are diversified portfolios, you kind of want to ask the question, how much are you into stocks and how much are you into bonds to benchmark their performance? You certainly don't want to give him a performance fee relative to cash if he's investing in stocks. That's using the CAPM. The CAPM is fine for that purpose. Yeah, I mean, the Fama-French three-factor model, if you want to understand a strategy in terms of, is this just another way of getting value, then you use the Fama-French three-factor model. Again, it depends on what you're going to use it for, and I'll let you go with your irrationality thing. If you think that the models are wrong because of irrationality, then that leads you to what kind of thing you want to use. I don't know. I mean, the problem is there is no irrationality for the moment is just an excuse for why models don't work. It's not a model of its own.
I mean, also CAPM is part of the reasons why a lot of hedge fund managers are able to get away, because they kind of use this wrong benchmark to kind of show that they have a high alpha, from what I've read about the markets.
So a lot of hedge fund managers are benchmarked to cash. So this is a case where the CAPM would help a lot. The hedge fund managers say, we're an absolute return fund. So we get 2% off the top and 20% of the profits, period. And then, by the way, it turns out we've got a beta of about 0.8, but we don't tell you about that. This is a case where the CAPM is a good first place to start. If somebody says, I want 2% of the top and 20% of the profits, asking them, oh, and what's your beta on the market? The CAPM isn't the only answer, but it is a good first step in many cases. And I think there's a difference between testing models, meaning is it 100% true, versus finding the model is still quite useful in many cases. So there's a case where even though the CAPM is not 100% true, we know value portfolios generate an alpha relative to CAPM. Nonetheless, if a hedge fund manager says, I want 20% of the profits relative to the interest rate, and is free to invest, a good question is, well, what's your beta on the stock market? So even wrong theories can be useful.
But then we kind of, sorry to one more, I know I'm taking too long, but like we know like models which are 99% accurate, like a VAR model, it can necessarily blow up under certain circumstances, and that's not the right approach to things.
That's right.
So and knowing that you are one of the leading practitioners of or leading professors in the industry, I mean, what would be your framework for going forward? Like, how do you kind of suggest we overcome these obstacles or overcome the shortfalls?
Oh, well, now you were going into fatherly advice. I mean, there is no one model for everything, and there is a big tendency, like you mentioned, VAR. There's a big tendency to trust big black boxes too much. You really have to understand what the model is trying to say, and understand, when it can break down. What are the assumptions that can break down? So models really, in economics and finance, they have to stay transparent. They have to remain quantitative parables. We can't do big computer models where we just don't understand the pieces. We understand each piece and then hope it adds up. That's proven time and time again not to work.
Cool.
So
thanks.
Leave it. Anyway, this is verging into the philosophical end of the discussion out here.
Thank you, John. Thanks very much.
Okay, those are great.
I think it's a good discussion. It's a good sort of endpoint as well. I was provocative earlier, but I think it's important to recognize that there's 5 decades of research got by here, and CAPM is a great first approximation. And the reason why we're still talking about CAPM is because to a first approximation, it's the best thing that we know. Your exposure to the markets is sort of, to my best knowledge, the best one-factor model that's out there.
Yeah, it's Newtonian physics. It's not Aristotelian physics. It's a good first approximation. It is a premium that you can get, and so ask the alpha against that premium. Fama French 3-factor model. That's the next step. As you saw with that transition, the good new models build on the old ones. We haven't thrown out the essence of the old ones and just started all again. And that's really encouraging. Finance is now a constructive science, not one where sort of fashions come and completely throw out everything that came before. With that, I think our hour's up and everyone's patience is being stretched. I want to thank everybody who's worked so hard on this class. You've warmed my heart that you're willing to spend so much time on this. And I want to wish you all the absolute best luck in your future careers, be it research or industry or whatever. Don't let anyone tell you otherwise. This is a fascinating time to work on financial issues, and there's so much we don't know. The big problem with a class like this is I've put together things and made it look like we have simple, clear answers, but we don't. This is the island from which to look out over the sea of things we don't know, and I'm only jealous of all the great stuff you're going to figure out. So thank you all.
Thanks, John, for organizing this. Thank you very much.
Thank you very much, everybody. Thank you.
Good luck on the final.
Bye.
Bye.